Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. Joining me today is Phil Goldfeder, CEO of the American Fintech Council and an old friend from my previous time at Lendit. Phil, great to see you again. How are you?
Oh, it's great to be here. I am doing very, very well. Todd, I will say that it was such a pleasure to work with you before, and to see you continue to take your talents and continue to build new ecosystems is just really exciting to watch, and happy to be here with you today.
Well, I appreciate the kind words as always. So I'll kick it off with kind of a broad question, and we can dig in a little bit deeper from there. But you've been in and around fintech for at least a decade. What would you say the status of fintech lending is today?
So interestingly enough, I spent an entire career in politics and public service before getting into fintech. And the gray hair you see today is all just in the last 10 years. My wife tells me it has nothing to do with my age and all to do with the work. I would say that, when you talk about online lending, marketplace lending, sort of it's gone through a transition. Post-recession, a lot of online lenders stepped up to fill the void that was left by the big banks who were de-risking at the time, given what was happening in the crisis. And that's kind of where responsible innovators stepped up to really fill that need. It has been an evolving marketplace over the last 10 years, where you've seen various companies sort of evolve their business models to ensure continuity and to ensure, most importantly, that they can continue to serve consumers in the most responsible way. And so you've seen some of the earliest companies in the industry, like SoFi and Lending Club, who took the path of purchasing banks and becoming banks themselves, while other companies continue in their partnership. I think today, fintech lending is stronger than ever. It continues to serve consumers, particularly in minority rural communities who are severely underserved by traditional finance. So it continues to do just that. But more importantly, in addition to just lending, most online lenders who have been around now for, I'm happy to say, we just celebrated Prosper. One of our board members celebrated 20 years.
Wow.
More than just lending, today they're finding new ways to serve their consumer base and offer additional access to unique and innovative financial products. So you're seeing a transformation, evolution of companies who once were specifically in online lending, today are doing so many more things. And that's really the foundation of where the American Fintech Council came from. I don't often tell this story anymore, but when I knew you back in the day, Todd, there wasn't an American Fintech Council. There was what was called the Marketplace Lenders Association.
Yep, I remember.
We rebranded as the American Fintech Council because marketplace lenders weren't only marketplace lending anymore. And we felt it important to widen the ecosystem, to broaden our partnerships and our collaboration in an effort to focus on best practice and ensure that we were representing consumers in a safe and a fair way.
So you touched on the role of AFC a little bit there. Maybe go into a little bit further on kind of where you sit. Is it helping with legislation in federal or state, and kind of what does the member base look like? Maybe just a little more context as to kind of the broader role of AFC and who the members are.
The American Fintech Council has evolved and grown. Where we started as the Marketplace Lenders Association and evolved, we took that as an opportunity to really diversify our membership and grow our membership. Today, we have almost 140 different members Marketplace lenders still are holding strong. Once upon a time, they represented about 80% of our membership. Today, only about 20 or 25% of our membership. And we've grown all the other aspects. And so we used to have only a few innovative banks. Today, our innovative embedded finance banks make up also about 25% of our membership. Reg tech companies, earned wage access, payments companies. And so we could really safely say we represent nearly every piece of the innovative financial services ecosystem. And that obviously gives us an ability to have a tremendous amount of influence in policy and regulation. And I would say that most traditional trade associations, especially those that are based here in DC, would argue that's their focus. That is their number one priority, is really thinking about the regulatory and policy agendas of Congress. What we have realized is, as we have grown with such diverse companies, is that the network effect has proven to be just as valuable, because we don't represent companies who've been around for hundreds of years, right? We represent new startups, or growing startups, right? Companies that have been around maybe 10, 20 years, not 50, and they're evolving constantly, right? The same way that the American Fintech Council has evolved, so has our membership. And the ability for different types of companies to talk about best practice, different product verticals, what struggles they've seen, how they've bettered themselves, and how they've managed to meet new consumers in different areas. It's really created what I like to say is the warm and fuzzy effect, right? Where you just have true collaboration in any other scenario, amongst competitors, what we would call competitors. They come to the American Fintech Council because we've really built an ecosystem of companies who recognize that we're only scratching the surface in terms of our ability to serve additional consumers in a safe way. And I would I would say there's two key differentiators for the American Fintech Council. Number one is that we're a standards-based organization, meaning our industries and our companies are going to work to define themselves long before regulators come in to tell them what they're doing right or wrong, meaning we strive for regulatory best practice. And to that end, we bring our membership together, whether it's in fintech lending, whether it's in embedded finance, or whether it's in earned wage access. We've worked to develop clear industry standards to enable to parse out and make a differentiation between responsible actors in the fintech ecosystem and irresponsible actors. But even more importantly, most trade associations focus on as a singular vertical. You see today, you have a lot of associations that represent innovative banks, and you have a lot of associations that represent, fintech companies. The beauty of the American Fintech Council is we've put everybody under one roof. And the ability for fintech companies to learn from innovative banks, the ability for innovative banks to learn the new ways and the new offerings and the new innovations at the fintech companies, and the ability for all of them to work together with each other to really build a strong foundation for the future of finance. And so we're excited about our continued growth. I'd say that just in 2025, we've already brought in 20 new members. Our goal is to continue to sort of build responsibly and appropriately to ensure that we can adequately represent the entire ecosystem.
Picking up on something you said towards the end there in terms of standards-based, what would you say are some of the concerns that lenders have today? Is it, some of the changes happening at CFPB and what that looks like? And is that going to eat away at some of the progress that we've made the last decade in terms of extending fair and less than, these super high rates, that type of capital, or a moving regulatory target? I mean, where are the biggest concerns in lending?
I would argue since the day of our founding, one of our principles or missions is that clarity is key. I think for innovative banks, for companies that are playing in the financial services space, they recognize they've stepped into a very heavily regulated industry. And so understanding what those regulations are on any given day and the evolving nature of those regulations is key for innovative financial services companies to be able to continue offering products and do it in a safe and sound manner. The challenge today, and I would say probably over the last couple of years, is that we haven't gotten the clarity or the guidance that we needed. I think that we saw from some of the largest federal regulators sort of hints at additional guidance, but we haven't really seen regulators over the last 4 years embrace responsible innovation in financial services. And to that end, it felt like we were on a roller coaster, right? We were really trying to suss out what we could from the little information they provided. And so as a bad example of the way regulation should be made by regulators, we were learning about a regulation by reading enforcement actions against some of our members, meaning or against other companies. And you should never have regulation via enforcement, right? To read the enforcement actions so you can then say, ooh, okay, clearly they don't like this and they don't like that, and they think that this is a challenge. We were encouraged, obviously, with the new nominations of regulators, but given kind of some of the uncertainty over the last few months in Washington, we haven't yet seen some of that leadership take hold. I would say the one standout has been Acting Director Travis Hill at the FDIC. Since he's come into office about 3 months ago and taken the role full time, he's already made a tremendous impact, whether it was about, on withdrawing the broker deposits rule that was wrongly proposed in the last administration, whether it was removing the amicus brief in an AFC lawsuit against the state of Colorado regarding their DIDMCA opt-out, or whether it was sort of arguing and sending a letter to FinCEN, arguing for clarity and modernization in CIP rules. We've already seen significant improvements and sort of adjustments at the FDIC. Unfortunately, given we're excited about the nominations for the OCC and for the Fed and for the CFPB, unfortunately, those members have not yet been confirmed in the Senate. And I think a lot of the chaos has just created kind of I don't want to say it's halted it, but it's created a slowdown in terms of the way you usually see agency leaders nominated. And so I think right now,
to pick up on that, I mean, does that change the way a startup or a Prosper or someone acts in the market? I mean, they're sitting there waiting. All right, looks like we have a regulatory friendly administration coming in. We might get some clarity, and then they're held up in the Senate for a year. It's like, how do they operate in the in between?
I love that question. So two things. There are, sort of in the interim, as an example, at the OCC. You've seen Rodney Hood step in to fill the void as an interim director, a controller of the currency. You've seen interim people playing roles to try and continue to move the ball forward. But from the innovative bank and fintech companies, our goal is still regulatory best practice, right? I want to be clear about that. Regardless of who is sitting in the chairs, we don't loosen our standards because of who's sitting in the White House. And I think that's a point that I can't make emphatically and strongly enough. The same
is there a misnomer about organizations like yours?
It's not. There is a perception of deregulation, right? There's this perception, I think, given sort of what's happening at the White House and what happened in the election, that all of a sudden regulation is gone, right? That the rules of the road are gone. Responsible innovators, right, members of AFC want rules of the road. I want to be very clear about that, because I think oftentimes you're gonna find industry associations who celebrate when rules get removed. We think about the world the opposite when it comes to regulation. We want to see, as I mentioned, clarity is key. Provide the rules of the road so people who are stepping into regulated industries know how to work. The challenge we're seeing is that in the perception of deregulation in Washington has created an uptick in states thinking that they need to step in to fill some void that really doesn't exist. And so we're seeing a lot of state activity, and AFC in 2025 has spent time in more than 28 states meeting with attorneys general, banking regulators, state legislators. We've really stepped up our state engagement, not because, like I mentioned, not because there's actually a problem in terms of filling a void. It's quite the opposite. Is reminding them and educating, I think, state regulatory and regulatory officials and policymakers that the structure hasn't changed. And I wrote an op-ed immediately after the election, sort of urging the continued hold the line in terms of where we are in standards to ensure that there is no disruption and that there is no need for others to step in and fill. All that being said, I'm excited to see Jonathan Gould and Jonathan McKernan and Mickey Bowman at the Fed leading these agencies, not just to hold the line on regulation, but to really rethink how we're being regulated, how the agencies collaborate with industry, how they go through their examinations. I mean, we've already started conversations about how do examiners look at traditional banks when they go for their examinations versus banks that partner with, like, let's say, fintech lenders, right?
Yeah.
How do they evaluate the risk associated with the activities going on? Over the last bunch of years, we've put everybody into this bucket of novel activities, right? And the Fed created a novel activity supervisory program, which was again, I credit to the Fed and to the program, but it was what we like to think of a very big bowl in an industry that requires very narrow lanes. And so we're excited for what the future holds. I am very optimistic, but that is not on the back of deregulation. And I can't be clear about that. We believe in regulation. As I mentioned, we're a standards-based organization that is going to support responsible rules of the road designed for the industries that are creating these innovations.
Speaking of legislators and regulators, given that you probably frequently talk to many of them or those in their offices, I mean, are there some common themes that come out of those conversations? Is it all AI? Everyone's either afraid or wondering about AI. I mean, what are some of the common questions that you get, given that you know the members so well, that you hear from those either that are in the legislative seat or the regulatory seat?
Yeah, this is a good opportunity sort of to give credit to my sister and brother trade associations, because what is so important is educating on the various new verticals within innovation. What you said is exactly right. When the new administration came in and they started to sort of talk about fintech, all you heard was about crypto, right? Yeah. Stablecoin, crypto, we're going to get legislation, we're getting executive orders, you're seeing agency initiatives. For those, who don't necessarily understand the sort of the wide offerings of fintech, right? As I mentioned, from earned wage access to buy now, pay later, to online lending, to regulatory technology. I mean, there's a wide variety of offerings. Oftentimes, everybody gets lumped together, right? Oh, yeah, the federal government's making all these moves on fintech, when in realization, they're really just talking about crypto. There was back, when I was a kid, there was a running joke where there'd be a poster on the wall, right? And it would say, sex. Now that I have your attention, make sure you go participate, right?
Yeah.
I feel like today that's AI, right? Like you see AI in these huge letters. Well, now I've got you, now that I've got your attention, let's talk about, how do you weed out fraud in your system? Let's talk about your compliance systems. Let's talk about your latest consumer offering. AI is run around like, the next biggest thing. And quite frankly, I don't think we're quite there yet. And I think what's a little bit frustrating, because we're very involved in those conversations, again, specifically with state regulators and legislators who become afraid of that, right? And and there's this reactionary regulating or reactionary legislating in areas where maybe they don't truly understand the use cases. What I often say to those policymakers is the members of the American Fintech Council right now, today, are serving hundreds of thousands, if not millions of consumers all across the country, right? It's not about what they hope to do. It's not about what they aspire to do. It is what they are doing today. And that, to me, is critical when we talk about our aspirational goals for fintech. We can't forget that we need to solve for the problems. As you and I both know, Todd, there's some issues within the online lending regulatory, within the online lending community with regard to the regulatory structures and boundaries that we need clarity, we need to work on. I want to get to AI and I want to get to crypto, but I kind of feel I don't want to forget that there's a whole universe of fintech and responsible innovators that need sort of some attention and some focus. And I'll I'll go into sort of one specific example. As you know, oftentimes fintech lenders partner with state chartered community banks. As I mentioned earlier, oftentimes examiners on the ground in South Dakota or in New Jersey or in California, all have their own thoughts and ideas about the way in which those banks should be regulated. But also, the vast majority of the banks that they're examining don't look like those partner banks or the banks that are playing in or operating embedded finance. And so, examiner education for us is critical, right? And that I don't want to jump over that so we can talk about AI or crypto. Again, nothing wrong with both of those issues, and it's something that we are very engaged in. But it's critically important to recognize the vast ecosystem that is.
Once upon a time, post crisis, fintechs were, hey, we're going to eat the bank's lunch, we're going to take over banks, and they soon realized they need the banks for a wide variety of their services. Very few have actually become banks. I think you've mentioned the two that have essentially bought small banks and have become banks themselves. But they still own the customer experience, and very much are the customer's brand. Do you see an evolution where banks continue to innovate and maybe compete more on that customer experience level? I know it's happened in pockets. Or do you see this balance kind of is the balance that we have going forward?
So first and foremost, let's dispel that notion that it was about competition and fintech companies eating into sort of the bank's bottom line. I think what we've all learned now over the last 10 years is that there is a pathway forward for coexistence and working together. But that comes back down to core competency, right? Everybody should approach the relationship with what is it you're an area, what is it you can do that you're an expert in, that you have the tools to do, and what is it that you don't? And I think oftentimes, sadly, and you see, unfortunately, what happens when it takes place, fintech companies step in to do things that they shouldn't do on the banking side, or banks step in and maybe innovate a bit too quickly in areas that they don't fully understand. When you put together a responsible community bank that understands the how to operate and function within the bank capacity, right? You understand what the rules and the regulatory structures are. You partner with a fintech company that, in theory is the front end, that is the customer engagement tool to drive, and you each kind of do what you're good at, and you put that together in a responsible way, you're able to create a system that's going to flourish. I think there was once a point where banks wanted to own the customer. I think you see now today in the embedded finance space, right? When you look at some of the fintech apps, the only way to know who the bank is to scroll down all the way to the fine print, right?
Yep.
There may have once upon a time been the thought that like, oh, the bank should be at the top of the website, right? Like right next to the fintech company. At the end of the day, the consumer wants to understand they're getting a safe, fair, reliable product. And so you have to, as consumers, you have to understand who the bank partner is. But the bank doesn't need to be part of that brand. It just needs to be a responsible player in the ecosystem. And I think, as I mentioned earlier, AFC prides itself on its ability and our ability to put both under one roof and to work together towards best practice, towards how do we move this industry meaningfully forward.
There's been a couple of recent incidents with fintechs and banks. How much do you think some of that either hurts the broader fintech and they get put in this box of like irresponsibility? Because when you think of the two, a bank and a fintech, people are going to assume the fintech is the irresponsible party because banking's been around for 150 years and it's had its issues at times. But when those two tie up, it feels like fintech gets the shorter end of that stick, even if the bad actors maybe are equally bad on both sides. But like how much has it, do you think, impacted the broader fintech ecosystem? And B, how does something like that ultimately happen? Is it that they went in with bad motivations?
Two things. Number one is all it takes is one bad incident, one bad story, one consumer getting ripped off, and all of a sudden the entire industry has egg in their face and is now in kind of a sort of a mad scramble to fix it and to talk about the benefits of fintech. To be very clear, that is the anomaly, right? Those stories that we read about, those are the anomalies, right? Not every bank fintech partnership are the ones that you're still reading about on LinkedIn on Sunday mornings, right? They're, the ones that you find themselves to the front page of the newspapers, those are the anomalies. And unfortunately, though, people read it, right? Whether it's policymakers, regulators, or consumers read those stories and they start to question whether their apps and their fintech companies are safe. Number two is, as I mentioned earlier, it comes down to core competency, meaning everybody has a responsibility in this, in the relationship. And the banks have a responsibility to their portion of it, and the fintech companies have a responsibility to their portion, and both should be held equally accountable when there is a breakdown in the system. That being said, is how do you prevent this? It's very, very simple. Number one, don't move too quick, right? I think where we saw most of the breakdowns in the system was when fintech companies felt like they needed to get ahead quickly, and so they started to maybe offer products before they should have, or before their relationships with their banks were solidified, and they started to push out products. And or banks thought, oh no, I'm going to miss the train on embedded finance. I better start onboarding these partners. And let's be honest, they weren't ready to onboard those partners. And so I learned this from a good friend of mine, Jesse Honigberg, who is at Customers Bank. He oftentimes talks about people, process, product, right? As an innovative community bank, you need to get your people sort of focused on what needs to happen. What should their mindset be as they think about evolution in their business model? Process. Okay, now that we've changed our mindset, how do we build the process to ensure? Do we have enough people in compliance? Do we have enough people in risk? Do we have enough people, right? Do we have enough people to support the potential partnership? And then finally is product, right? Now that I have those two things in place, I can think about product or partnership, right? In terms of how can I actually, and this is something I get from Eric Sprink, who's the CEO over at Coastal Bank, who says, I'm not looking to move too quick. I want, one good partner, a year to really think about how we continue the evolution. Two, right? And it doesn't, you never hold them to the numbers, but the thought is, I don't need 58 partners or 58, fintech companies at my bank to be successful. I need the right ones. I need the ones that understand what we need from them, what they can do for us, and how we can move, and how we can be successful together. And to me, that's the right mentality. I think both of those people have come to this ecosystem with the right mentality of how do we build a foundation for the future of finance that hundreds of banks after us can come and understand what we've done and build on that. Because ultimately, there's a lot of consumers who are still underserved all across the country. And as you see community banks, traditional community banks, continue to shutter their doors and branches get closed, it's critically important that we do fill that void, because ultimately it's about access to financial services for families long left behind. So we have a responsibility, but again, that doesn't, it goes back to organic shift. When you're a fintech company and or a bank and you're making a hard right or left turn, that should give you pause for, let me slow my car down and figure out if I'm doing this the right way.
Has there been a bit of a collective issue amongst the innovators, generally speaking? Like, we need to say we're overhauling or we're going to innovate so fast that you're going to blink, and it's like, none of this happens in 2 years. Everything happens over the course of a generation. It's like crypto. I always felt crypto did themselves a disservice when they said, this is going to transform everything in 5 years. And a lot of those companies are now gone, and the ones that slowly built are the ones that are obviously, running the ecosystem today.
Yeah, Todd, you think about it, their mistake was self-created, right?
Yeah.
There was the rush to serve consumers is fallacy that you're going to miss some sort of train or you're going to miss the boat. We continue to innovate. Again, I get new members literally every single week. Each one of them is offering some nuanced service. We just onboarded a company called Flex that is enabling renters to split up their rent over the course of a month, right? Most renters have to pay their rent on the first of the month, right? Flex is an innovative company that has created opportunities for renters to split up their rent. And by the way, it's not just about that, right? Because oftentimes there's a ripple effect, right? There's a downstream effect, right? Now that you've relieved the pressure on rent, you've relieved their entire financial, outlook, and you've enabled them to operate a bit differently. And so these companies, I would say years ago, when you think about a company like Flex, no one could even imagine doing that, but today we can.
Yeah.
Think about earned wage access is another great example. There's no reason why we have to wait for the 15th or the 30th of every month to get paid. Employees should be getting paid every single day. And more importantly, employers should want to pay their employees as often as possible. Why, if I've worked a day, why shouldn't I get paid? 10, 15 years ago, who would have thought, right? Who would have thought that you can get paid every day seamlessly?
Yeah.
And today, this is what's possible. And so I wish I could tell you what tomorrow will bring, but for responsible innovators, I think, there's no limit to the additional services you can offer communities. And here's the best part. You don't have to compromise on consumer protection. Quite the opposite. You can maintain and those rules of the road, maintain consumer protection, but find new innovative ways to serve the consumer.
One final question before we jump into a couple of fun ones to wrap up. Picking up on the access to financial services. I mean, is credit too easy to access today? Given you can go into a store in 2 clicks, you can get a loan, or I can go online and in a handful of clicks get $30,000 the next day. Like, I know some of it comes down to underwriting, but we've made it very, very easy, and we've essentially made it seamless to get money. At some point, is it too easy?
I'm gonna bring you back 75 years to the 1950s when credit cards fell from the sky. Literally, credit cards were mailed out to tens of thousands, hundreds of thousands of people overnight. And the exact same question was asked, right? Are we making it too easy for consumers? I don't think there's a really good answer to that. I think that consumers need to understand that every form of credit has its benefits and has its downsides, right? And at any given moment in your life, calls on a different product that you should utilize. And as an example of that, there are some days or some items that you want to purchase that, using a credit card is the right tool in that moment for whatever reason that consumer determines what it is. And then there's some times where a buy now, pay later is a better product, right, to utilize because again, every consumer operates differently and every consumer manages their finance differently. And so ensuring that you're creating maximum optionality, I think, is key. So I don't think there's too much. What I would say, and a word that we use, to death around here is responsible innovation, responsible credit, meaning it's not about credit for credit's sake at whatever cost. AFC has long believed in things like interest rate caps, like, other standards that create certain parameters to ensure that the consumer is not harmed by the product. And so when we think about access to credit, oftentimes, in our communications teams, it's been beaten into their head. It's not just access to credit. It's access to safe, responsible, affordable credit. And to me, those 3 words before credit are just as important as the credit itself. And so to me, it comes back down to not too much, but optionality to enable that consumer to make the best choice.
A couple of fun questions as we head out the door here. Favorite sports team or hobby?
New York Yankees. I am a child of the 90s in New York. Now, I am from Queens, so everybody just assumes that I'd be a Mets fan. Growing up with Derek Jeter, you had no choice but to be a Yankees fan.
Well, I chose the Mets, so.
Sorry to hear that. Although you're doing pretty well these days.
Yeah, that might turn. That might turn soon. Tell us one surprising thing about yourself.
I am an introvert. I know that I spend a lot of time on the road and I'm out there, but when a push comes to shove, you give me a good book. I rather sit on the couch, in my downtime and read a book than be out and about mingling with my friends on the weekends. Just this past weekend in 2 sittings, I just reread Too Big to Fail. And so my wife
wow.
my wife often questions, like, you're always out and about. And yet for me, sometimes I think maybe that's the balance, right?
Yeah.
When the opportunity presents and I can take advantage, I rather, be in my house all alone, reading a good book.
Most exciting part of your job?
The people, by far the people. It's, every given day, on any given day, I have privilege and the opportunity to meet some of the smartest, most thoughtful innovators across the country. And the opportunity, whether they're members or not, to pick their brain and be able to really dig deep about what they're trying to accomplish and how they're getting there, and learn from their successes, learn from their failures, to make me and our organization even better is just something I love to do. And it's something I get to do, which is very exciting.
And final one prediction for the next year.
I think the chaos, and I feel like, given I'm sitting in Washington today, I think that sort of the current chaotic sort of news cycle that we continue to find ourselves on is going to go away. Like, I am a believer that you're going to see sort of industry settle, government settle, and sort of folks allow things to breathe. I think oftentimes we live in a very reactionary society, right? And so, again, and I'll say this, and let's just be frank here, right? The president takes office and instantly is trying to react to maybe what was perceived as 4 years of things that required reaction. So you're seeing a lot of that today. And then you're seeing others sort of react to that, right? And so you're seeing a lot of this. You can't catch up. I believe that over the next few months, and maybe this is less of what I believe is going to happen, and just hope and pray will happen, is that we're going to get to a time in government and particularly financial services regulation where we're no longer reacting, we're collaborating, we're thinking about best process and best way to move forward, and we're actually going to get there.
Well, I hope that happens for all of our sake. And Phil, it was great to see you again. As always, continued success with AFC, and look forward to seeing you sometime in the near future.
Amazing. Thank you so much, Todd. Hope to see you soon.
Thank you.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.